Hello and welcome to Trading the Trend. My name is James Boyd. Today's date, January 8th. Myself, a redhead, and Connie are going to take care of you here today. She's also a redhead, so some of you kind of mentioned that. So as you can tell, that green shirt matches my hair. So some of you were wondering where this shirt was. I wanted to pull it out for you. All right, a little fun there. Now just remember, we do post educational content on X. There's my handle there. At James Boyd CS, Connie will post her link in the chat. That way you can just click on it and follow her as well. Also, quick reminder that if we want to just quickly recap some of the things that we actually discussed, okay? So we've really been more on a schedule, or we're kind of creating a series, and you're going to see that we talked about these strategies. Now, these strategies can be taught in other classes. However, these strategies we talk about will be specific for this class, and the rule set that we talk about will be specific to this class. Now, so one thing is, if you said, well, where would I actually find past recordings of these? Simple. Go right up here to the top. And what I'm going to do is I'm going to send this out to you. Okay. Now, remember, when you go to this page, now, by the way, if you went to just schwab.com by itself, okay, so let's imagine you just went to say schwab.com. You went to a schwab.com, you haven't logged in yet, you're going to go learn, you're going to go to Coach Schwab Coaching right there. So go to the tab learn, then go to Schwab Coaching. Goes right to this page, which I sent to you. Live webcasts and virtual workshops. Click on that, which is the second tab in there. And now what we see is the calendar, okay? So first thing what I want you to kind of notice here is this is a calendar for January. Where's December? Click on the back arrow. Why am I going to do that? Well, because some of those classes were taught in mid to late December. So if I actually go back up to this and say, let's go back to December. And what I want to do is I want to go to coaches right there, just James Boyd. Anything that I taught in the month of December is going to be listed right there. There is, so if we go back, trend trading was on the 18th. There is trend trading. Just got to click on it, okay? If we go to, let's say, swing trading, we said the 22nd. There's the 22nd. There's the 22nd, okay? You're also going to see, if we take a look at that, the covered call school. We said the 23rd, right there. Married puts, right there, okay? 29th. There's, we said also the callers, the 30th. You're going to see right there. Okay. Now, if we go into literally the month of January now, go to January, anything that I taught in January, pull it up. You're now going to see, we talked about buying stocks at potential discounts. Okay. That was short puts. Okay. And then what you're now going to also notice is trading the trend today, the 8th, which is short put verticals. Now, I did make mention we wanted to devote an entire class to caller management. And then we want to devote an entire class to something that I've talked about in the past, but I'll definitely review it again. Why not? Is how do you know when to maybe pick a certain strategy? Now, we kind of talked about that individually, but I want to collectively bring it all back together and put it in context. So that's actually how you find that. So I just want to answer that question right off the bat. If you're not on X, get on X. Now, you might say I'm not a social media person. Either am I, okay? I don't use X for social media. We use X for business, and it's a way to actually connect with other people out there in the world with investing ideas and just kind of seeing what's out there. So just real quick as we get going here, let's hop right in. Just want to answer those questions right off the bat. As we talk about short put verticals here today and look at a couple examples, remember that options are not suitable for all investors. So when we also talk about the information, it's provided for general informational purposes only. And also understand that when we bring up examples, they are just that. And also remember, when we talk about those examples, we will do those in the Paper Money software application. Investing involves risk. And also when we talk about probability analysis, it's theoretical in nature, not guaranteed. It's dynamic. When we also talk about those examples, we will show examples by using technical analysis and also identifying the trends, hence the class. Before we hop into short put verticals, just real quick, let's go ahead and just take a quick look at the market, okay? Now, Amazon punching away 430 to the upside. You're probably watching some of those big boys. We made mention of the NASDAQ yesterday. Could that actually break out to the upside? It's kind of slanted back here today, but actually some of those NASDAQ stocks have actually done quite well, such as Google, okay? That actually went up to a brand new high here today. You saw the Amazon, among others. Probably one of the biggest horses to the upside has been yours truly, Costco. You knew it was coming eventually. Okay, as you're standing in a mosh pit to check out, I usually go probably 4 times a year, so I don't know that much about it. But the biggest actually thing is pretty good move actually back on Costco. Probably one that we said keep an eye on also kind of for some unusual activity was Target. Sliced its way through an old resistance and very quickly sliced its way to the middle, to the top. And what we're seeing is a candle that literally, it only took 2-3 days to actually go to the channel from really the bottom to the top. And a huge candle. If we close here, we're actually outside the channel. So keep an eye on this. A little unusual derivative volume. I didn't check stock volume, but actually kind of unusual on that. Could this be like an activist type play potentially, like we saw with Southwest Airlines? And could there also be maybe some leadership change? The stock is kind of trading like that. Okay, some unusual movements as of lately on Target. Now, I want to actually kind of hop right back into just real quick anything else that kind of stood out index-wise. Well, I think we got to say the Russell. Russell smashing. It's actually way higher. Smaller caps. Now, again, this kind of goes back to if people are buying smaller caps, you know, you ain't buying smaller caps unless you're kind of more confident on where the economy could be going and where rates are probably going. Second, when we actually also take a look at, let's say, the energy not completely falling down completely and just not getting a bounce. Big bounce back on energy. Probably the biggest one that we're seeing here today is those dividend investors putting their capital back to work in the consumer staple space. Not a bad move on dividend stocks. Quick reminder that those dividend paying stocks, those dividends could be cut, raised, okay? It's not indefinite. It's up to the company and the board to decide what is their dividend policy, even if they're going to even have one, okay? Discretionaries, that does not look bearish, ladies and gentlemen. Little crossover on the discretionary, the sector itself. We actually also see the, say, the transports, that does not look bearish either, okay? Okay, all right, let's just go to work here. Now, remember what we kind of made mention, what we want to do is we want to actually think of this like you're an investor that has experience, okay? Not just a general interest, okay? But you actually have a sheet where you write down what are your goals, okay? And then what are your main strategies? Those strategies we talked about like trend trading, right? Swing trading, etc. And so we were just using Excel. So this sheet would just be like a summary. This sheet would just be like trend trading. So every one of these sheets would actually really be like your plans that are written down. And so let's imagine here we are on this other plan, and we're just going to call this short put, down at the bottom, short put verticals, okay? So think of this as your tools, your strategies, okay? So here we are on this. Let's kind of imagine we're working on this next one, okay? Now, by the way, this should be very, you might say, I really like this because all these plans are not completely independent, okay? You're going to see that there's some correlation between short puts and short put verticals. Exactly. So if you said, James, I actually did not go to that class on Tuesday, okay? And where would I actually find that? Well, just go right back to that class right there, okay? Now, here's the deal. I'm not going to give it to you, okay? Go to the Schwab.com, go to Learn Schwab Coaching. Get used to using this calendar, okay? That way you could actually just, by the way, there's not just this, there's other things, but get used to it, okay? You can actually go to that class right there, click on it, watch that video. What we talked about today, is going to link back to this. Now, if we actually talked about this short puts, okay, short put verticals, okay? Now, we just added one word, short put, okay, selling a put, which is the obligation, short put verticals. If we actually said kind of what is really the purpose of this, well, you probably won't believe this, but the number one goal is to trade higher priced dollar stocks. Now, if you actually pulled up just real quick, and we're going to kind of apply as we go. If I looked at, let's say, the Dow Jones Industrial and said, what's the, like, you look at all these stocks in the Dow Jones, 900 bucks, 600, 400, 300. I mean, you got to look down here and say, how many stocks in the Dow are less than 100 bucks? Answer is 4. That's it. So when a lot of people look at, let's say, these NASDAQ stocks and say, well, or S&P 100, how expensive are they? Can they buy 100 shares of these stocks? 100 shares of these? Well, if we look at the S&P 100 and said, how many of these stocks are less than 100 bucks? I mean, we're going to have to get down to the bottom. So my point in actually making this first comment is, a lot of people say, well, yeah, with the index at all-time highs, the stock prices, many of them are a price higher. And therefore, I can't buy that many shares. Hello, welcome to short put verticals, okay? So we're trying to actually use short put verticals as the number one way or number one goal to trade higher price dollar stocks. The other thing that actually we're trying to really do here is we're trying to have a lower delta strategy. So when we say a lower delta strategy, we're talking about a reduction in profit or loss if the stock was more volatile. Now, that's a huge one, because one of the things is when prices move up and down, up and down, up and down, we tend to overanalyze it or over-internalize it, that the stock is moving up, actually up and down. So lower delta strategy means if it goes up or down, it's not really getting hit dollar for dollar. It's a fraction of that. And the other thing we're actually trying to do is lower delta, okay? And we're also trying to have positive, okay? Positive time decay, okay? Or theta, okay? And also with that, this one is a big one. We're trying to neutralize, okay? Volatility. Gosh, that is so hard for me to spell. I'm joking on how I spelled that, but let's go for it. Volatility, okay? Now, so here's the deal. On the short put, on the covered call, we did not neutralize volatility. That was a risk. If you sell a call, you sell the put, and the volatility goes up, that could influence the position as far as the profit or loss. By doing the verticals, the short put verticals, specific for this class, man, we are trying to neutralize that. So really, when we go back and say, what is it trying to focus on? We're trying to get the direction right, up or down. Second, we're trying to have that positive time decay. Why? Well, because the only thing that's constant is time, okay? That's the only thing that's constant. Now, the number two goal kind of with this is, the other reason is we would say, why does someone actually do it? The premium. And the second goal is potential stock ownership. So hold on for just a sec. That short put is an obligation. We're doing it actually for the premium income potentially, but also that short put could become potential stock. So let's connect the two together. We wouldn't do a short put vertical on something where you didn't want to own the shares. Okay, we good? Now, if we actually talk about kind of the considering application, when, okay, the biggest actually thing we would actually say is trend one. This is probably a VIX, okay, VIX greater than 18. What does that actually mean? That actually means that price is below 10 30-day moving average, okay? Now, that also tells us that the VIX is greater than 18. This also probably tells us at that point, probably higher or highest IV. Highest IV probably means higher premiums, equaling lower break evens. Okay? Now, could you do it actually in trend two? Yeah, sure. It's just going to be a little bit less. Okay? Trend two, yes. Trend three, yes. But it's going to have lower IV, which actually means lower premiums. You still could do it It's just not as high as in trend one. Trend two, it still has most likely, okay, higher premiums. If you actually said, could I in trend four actually do, let's say, I'm going to say lower to lowest IV, which equals lowest premiums. So this is where you're going to start to run into some issues. Hey, James, it's tougher for me to really find, let's say, setups where I'm getting paid enough or per what you want to actually get. Now, the biggest actually thing I want to kind of point out here is, I'm just going to verbally speak to this, okay? When we talk about trend one, and I'm going to kind of label this as trend one continued. We talked about on Tuesday, we talked about if you were going to do a short put vertical, and you were going to do it at a horizontal support, no divergence. Well, many investors, they say, look, if the price is actually falling down to the horizontal support, there's no divergence, no MACD divergence. Many investors like that setup, do a short put vertical, because the investor has a defined risk. So when we talk about the short put vertical, we're talking about selling a put, and that equals a short put. And the biggest actually thing is we're buying a put equals a long put. Just want to clear the lingo here, okay? Now, this is me, okay? I don't think many people really understand what buying a put really is. Buying a put is the right to sell. This is what defines the risk. When I think of selling the put, this is where the investor buys at the strike price from now until expiration. When someone buys a put, they have a right, okay, to sell at the strike price. So if we sold, let's say, example given 100, we sold the put at 100, we got to buy the shares at 100, but if we actually bought the put at 95, we have a right to sell at 100, sell at 95. So it creates a floor, a defined risk, okay? Now, we also talked about, let's say, trend one on Tuesday, where we said, hey, if we're down near horizontal support and there is a divergence, that would be more conservative because you've actually waited for the price to fall down to horizontal support. There's a bullish MACD divergence, and you actually take that entry. When we say a horizontal support and no divergence, this is what we would call an aggressive entry. When we say horizontal support and with a divergence, okay, and divergence, we would actually say more conservative. That doesn't mean you can't lose in either one of them. It's just kind of saying the timing is, you're kind of waited for the timing. Now, when we also talked about, let's say on Tuesday, kind of about the setups, right? We talked about those bullish price patterns. And I'm just going to kind of speak to them. I'm just going to write one word: W patterns, diagonal breakouts, moving average crossovers. Answers all the above, okay? Now, the biggest actually thing what I want to kind of talk about is this stock IV. On this strategy, we'd probably be thinking a little bit more of looking for stocks that maybe have 35 plus IV with 40 days to expiration. Hold on. With 20 to 50 days to expiration. Okay? Now, if we also saw something between, let's say, 25 and 34, that's going to be probably fair IV, okay? And with the 20 to 50 days expiration, and if it was only 15 to 24, you're just going to kind of see lower IV, which also translates into lower premium, which also translates into lower ROR, which stands for return on risk. Okay, now, I want to kind of point out something here that is more important with this strategy than what we talked about on Tuesday. When we talk about this strategy, we're looking for options that have a spread no wider than 20 cents. Now, could you do an example wider than 20 cents? You could. The wider it is, the more or less likely it's going to be that you're probably going to be able to get in and get out at a fairer price, okay? Probably going to have to hold on to it a little bit longer to get it to move or have that time decay go by. The reason why on this strategy it's so important is because you're selling the put and buying the put. The key point is you are on both sides, okay? Now, just like we actually talked about, and this we're going to now turn it loose to examples. When we talk about the expiration, the strike, this is going to be same as Tuesday, okay? Refresh my memory, 20 to 50 days to expiration, and we're going to look to be selling a put with a 30 to 40 delta, which means out of the money. The put that is purchased or long, okay, that's going to be 1 to 2 strikes OTM, out of the money. And when I say that, we're really saying below. Why do you not know if it's going to be 2 strikes out of the money? Well, you can't assume. You got to go look at the strike and say, is there liquidity there? You also might be doing 1 strike wide because you can't do more than that per position sizing. You might say, well, I can risk more, therefore I could open it up to two strikes and just commission less because I'm not actually doing 2 contracts. I could just do 1 contract since we're doing 2 strikes wide. Now let's go to some examples here, okay? Now I want to go back to just real quick, this speaking of higher price dollar stocks, let's go back to Google for just a second, okay? Now, I can't wait to read the first person that tells me too high. There were some comments yesterday when I showed this. I'm waiting. I'm going to look for another one. Okay, yeah, go ahead. Go ahead. Okay? Now, if we took a look at this, let's say we tried to say, look, 20, 50 days to expiration, delta 30 to 40. The purpose of a delta of 30 to 40 is you're saying, look, where do you think the stock is going to stay above? Many technicians might say, well, I think it's going to stay above where the support level was. Was this old resistance new support? They might visually look at that chart and say, I want to sell the 315. Why? Well, because they think it could stay above that. They might try to go down to sell the 310. Why? Because actually where they think it could stay above that. They are also saying at the same time, that's where they might want to buy the shares. Because remember, if you sell the put, you have a standing obligation from the time you place that trade all the way until expiration and or you close it out, okay? Someone could assign those shares to buy. Now remember, if you buy those shares, they're your shares. You could do what you want to do with them. Check liquidity. Sell all. Sell some. Sell none. They're your shares. So if you do short puts, if you do short put verticals, it's with the idea that do you want the shares? Now, you probably think, well, I want the shares because there's a trend. There's maybe some dividends, etc. Okay? Now, the biggest actually thing, now, by the way, if you're assigned, and let's say you say, my gosh, this is just too big of a position for my portfolio, that's where the investor might say, I'm going to sell some to lower it down to where the portfolio could handle such an investment based on the position size. All right, now let's go to work. I'm going to go to the trade tab, okay? Now, what I'm going to do here is if I go to the trade tab, trade, that one, let's type in there. Now, we're going to talk about the position sizing in just a moment. If we actually go down to waiting for the data, trade grid, okay, there it is. Now, we're going to go down to 20 to 50 days to expiration. We're going to look at, like we said on Tuesday, the monthly options. Why there? Well, that's probably where we tend to see the most liquidity. Tend to verify. If we take a look at this, I'm also going to bring up, let's say, this, and I'm going to change, let's go change this to theta for just a moment. Let's change this to volume, okay, volume. Let's change that right there to open interest, okay? Now, we got calls on the left, puts on the right. If we actually sold something out of the money, delta 30 to 40, it's going to be right in the ballpark, right around 315. Can we assume there's liquidity? Is every strike the same liquid? No. Well, that's 10 cents wide and it has almost 12,000 contracts. Might interest some people. This one, 315, has 1,700. It's 15 cents wide. Okay, so some. And if we look at that, that's really the highest we would sell, meaning the highest strike and the highest delta. Well, if you take a look at this, if we said, look, I want to actually sell something that has a higher probability of being above the strike. Now, the delta of 30 is actually saying two meanings. Number one, what's the likelihood as of right now the stock is going to be below the strike by a penny at expiration? As of right now, 30% chance. All the probability is something to 100. There's a 70% chance as of right now that the stock could actually be above the strike. As of right now. We're going to right click on that 310, and then what we're going to do is sell, and then we're going to go down to where it says vertical. Now, when we actually do that, okay, this is where the question really gets brought up is, well, how many could we sell? How many we want? No. How much are you willing to risk of the portfolio? So if you said, well, James, I am willing to risk, let's say, no more than $350 on a trade. Well, when I actually go confirm and send, you're now going to see in this case, well, how much is it per contract? We are right at the threshold. Okay, there it is. Matching that credit there. Okay, it was off by 5 cents. So there it is, max profit. There's that max loss. So when would someone use a 1 strike versus a 2 strike? This is a 1 strike example. Why? Because if the investor says I can't risk more than 350, it can't widen out anymore. Can only do 1 contract. Okay? Now, what you're also going to now notice is, well, what's the premium? Well, this is where we're going to take the 150, the maximum gain, divide by 350. Okay? And where are you seeing those numbers? We're just looking at these numbers right there. So that right there is the max gain, MG, and the one over to the right-hand side is ML. What we're now going to see is what the percentage is. Now, for many investors, they want to see a minimum 20%. For some investors, you might be different. Some might actually say kind of more average, given 20 to 50 days to expiration, might be, let's say, 30%. And if we actually saw a high percentage, okay, I'll just let's write it out. High, probably 40. 40 does not necessarily mean better. It just means, A, there's probably a higher volatility on this. You could be selling the short strike closer to the current price. There could be more timed expiration. Those are some other factors that can influence that. But when we look at this, if we ran the percentages, what would it be? Well, just take one number divided by the other, 150 divided by 350. The answer is 42%. Now, what is kind of telling us that it might be that high? Answer is what we've been talking about, volatility. If we actually have that number 35%, it wouldn't be unthinkable to think that that number was probably going to be pretty high. It's not unthinkable, okay? So if we said, hey, we could do, now stop for just a second. How many trades in the last 3, 5, 7, 10, 15, 20 years have you missed because we had the thought in our mind, well, I can't get in because it's too expensive? Hey, if you had $1 every time someone said that, you'd be a millionaire. Okay, just on that alone. So the biggest actually thing is, the investor might consider using options to just trade some of these higher priced dollar stocks and get exposure to the trend. Not just watch them, try to ride that trend through the means of verticals, short put verticals. Now, the biggest actually thing is positive delta, bullish, positive theta, trying to get money from time decay. But probably the two biggest pros of verticals is really that, A, it's neutralized on the volatility for the most part. And the last part of that is defined risk. The worst part about this trade is if the stock goes up a lot, you're going to wish you never knew what a short put was. Okay, we've all been there. And why do I say that? Because if this stock goes from 326 to 400, you're going to say, yeah, I mean, that's so great, but cap gain is only 150. So, you got to be watching it. Did you roll the position? And we're going to talk about that in just about 2 to 3 minutes. So now what we're going to do is we're going to go ahead and send that order. Send. And there it is. Now, the other thing that I would kind of make mention is how much money is being tied up to do the position. Well, whatever the max loss is. Okay? So if the max loss was $350 and we did 1 contract, how much money do we have to set aside to do the position? $350. All right, now let me actually go back to just real quick one other one. I'm going to go back to a little small company we have never heard of before, and it's called AXP. Now, if we looked at this and said, do we actually have a trend here? Is it upward trending? Are we above support? Is there any type of bullish technical analyses on the chart? Yeah, it kind of looks like it. You got a little crossover right there. Maybe the stock kind of punching up into the area of resistance. Now, remember, a lot of people say, got earnings coming up, got earnings coming up. Yeah, we understand. But this is kind of what's attractive about short put verticals. Define risk. If it gaps down, it can only be so bad. Let's go and actually see and just verify with our own two eyes if it's liquid. Okay, so the first thing I'm going to actually take a look at it is there's some liquidity, and I'm doing this on purpose. Okay. If I went and go look at, let's say, the 43 days to expiration, and I just look at the first out of the money call, the first out of the money put, is it liquid? I'm doing this on purpose, okay? Well, it's not as liquid as it was before, okay? And that's true. So could someone do this? They could, but just the wider the bid-ask spread is, the less the investor's probably going to get in, out, in, out, in, out, in, out, because there's just a wider bid-ask spread, okay? When it's tighter together, they might get in and out more frequently because there's a market for that right now. So I'm going to show this example where, hey, let's say the investor says, I'm still going to do it, and I actually want to, for example, try to go down to a delta 30 to 40, which is going to be the 370. And if we actually do this, now remember, that right there is 65 cents. It's wider than what I said. I'm showing compare and contrast. Sometimes that's how we learn. That's okay. We're going to right click on that 370. And what we're now going to do is going to go to vertical, and we're now going to go down to the 360. Now, let's check the numbers. Can you tell me what the ROR is? Remember, you're an investor. How would you be an investor if you can't figure out rates of return? I mean, I think that's foundational, right? So what was now it wasn't advanced. We just took the max gain divided by the max loss. And you could even actually have the table show that for you, but let's kind of use our brains, okay, ourselves, and it won't even take that long, okay? So all we're now going to do is 275, okay, divided by 725. That's not that bad. What's the number? 38% if we round up a tenth. Okay, now, what can influence that? Time to expiration? Are we selling closer to the strike? Where's the implied volatility? That implied volatility is right at 31%. Let's say we said, hey, I can, for example, have $2,000 of risk, no more. How many contracts would it be? Well, in this case, okay, in this case, the investor could do not 3, but 2 contracts, okay? So now what I'm going to do is going to come back, go edit, change it to 2. So it's not based on what the investor wants, it's what they're willing to risk, okay? Now, when we actually come back, and when we talk about these entry signals, and I want to spend the rest of the time on management, it could be the stock is in an upward trend. The stock is bouncing off support. What are the 2 words or acronyms we use for bounce? Hold, close above the high of the low day, CHG, close higher gap, all the above, okay? Could it be a breakout? Sure. Could that also be maybe, let's say, a moving average crossover? Sure. Could a moving average crossover be a breakout? Yes. Could a moving average crossover be a bounce? Yes. So the moral of the story is what we're saying is look for the trends above price, above support, bounces and breakouts, all the above. Okay? Now, if we go to confirm and send, note the 2 contracts. The key thing to watch right here is, again, whatever the max loss is, that's how much needs to be set aside to do this trade, $1,460. Now remember, for every 1 contract, it's going to be $1.30 per contract. So if we did 2 contracts, it's really, in this case, going to really be $260, okay? Now, notice what the break even is at expiration. That break even at expiration, in this case, is $367.60. Now, what's kind of nice about that is it kind of gives us some room, from 383 down to 367.30. And if you ask most people, hey, can your stock actually go down and you still potentially be profitable? Most people would say no. That's why some people like selling strategies, okay? You're trying to trade probability. That is also why you don't actually have a bigger profit per the loss, is because you have some potential give back. As long as the stock stays above 370, you could still be at maximum gain at expiration. Send the order. Now, so we did 2 trades. I want to spend the next 10 minutes and kind of talk about really the management of the position. And I want to kind of talk about it in what we talked about on Tuesday. And what we talked about on Tuesday was, I want to just look at just want to kind of talk about the gains first. Okay. We're going to label as gains. Okay. And then what we're going to do is we're going to kind of label here 4 to 10 days to expiration. Okay. 4 to 10 days to expiration, DTE. And then what we're going to do is we're going to label this as expiration. I'm a sucker for a good chart. Okay. A good table. I love me a good table, because if I can kind of put it in a table, it probably is showing me, okay, I get it. Okay. Now, what we actually said on Tuesday, same thing what we actually brought up with short puts, is if we get 50%, okay, of max gain, okay, in first 10 trading days. That's key. You'll see why here in just a sec. First 10 trading days. So if you get 50% of the premium in the first 10 trading days, the investor might roll, okay? Or they actually might just exit in general. They roll if they think that trend could continue. They might roll to the same expiration month if there was more than 20 days to expiration and they were liquid options. If they say, no, I'm going to exit only, they're really saying in this case, look, I think the move was made. I was able to get that 50% in the first 10 trading days, and I just want to exit the position now. I'm not going to. So when you roll, you are reestablishing the position. Just want to go down a little. There we go. Okay, now, what the 60, we talked about 65%. 65% when 20 days to expiration plus. Okay, now notice it's not trading days. If the investor has 65% of the max gain, when there's more than 20 days to expiration, they might say, hey, that's a really good gain considering I haven't gone inside 20 days expiration. And we said the other day, which is 80% ever. So wonder if there's 14 days, wonder if there's 24 days, wonder if there's 34 days, ever, okay? The only way you actually get 100% is you go all the way to expiration, or the stock moves massively in your favor, okay? But you probably still won't get 100%. You could get close to there. The only way you get 100% is you let it close. It closes above both strikes. If it goes up massively in your favor, you'd probably be closer to 100%, but probably not quite, but it'd be close, okay? Now, I want to talk about this 4 to 10 days to expiration. So in this case, we're saying, look, we're 4 to 10 days to expiration, and the price has actually gone up. So the price, okay, is greater than the strike. Okay, now you're 4 to 10 days to expiration. This is the up scenario. Up. The stock price is greater than the strike. Now, you got 4 to 10 days to expiration. What risk do you have? Well, number one risk we got to be thinking about is what percent of max gain MG do you have? What percent of max gain do you have? Now, I know we want 50%. We want 65%. We want 8. Okay, but what if we only have 38? Well, the investor might say, look, I wanted something higher, but now what's happening is I'm running out of time. This has now become forced. We do not have till infinity of time. So what if there's only a 28% gain? Well, if they're not at those percentages they want, you got to remember is you could actually have assignment even though you're not at expiration. This is very important you understand this. These are American style options. These are not European options where it can only be at expiration. So if we start getting closer and closer to expiration, the assignment risk could be going actually higher. The investor only has 27% of the maximum gain, example given. They might say, hey, look, I'm going to roll the position, okay? If they actually thought the position, and they would be rolling out in time, or they might just be saying, look, I don't think it could go up anymore. I don't like the trend. They're just going to exit in general, okay? So sometimes you got to understand that getting something is better than nothing, okay? Now, I want to kind of talk about this second part. What happens if the stock is kind of more sideways to slightly down? That's an equal sign and a down. Now, this is kind of where we say it's in between. Now, wait, if you're in between the strikes, what's the potential risk? What's happening? You probably have a the percentage gain, maybe. You might be above break even. You probably are going to have a greater chance to be at a percentage loss. And the biggest actually thing in this case, you actually face the risk of what? Assignment. Okay? So if you said, hey, James, I'm in between the strikes and I'm down 20% of the maximum loss, I'm slightly below break even, I don't want to be assigned, then the investor might say in this case, look, I'm going to take the big exit. I want to get out of the position, take a portion of that maximum loss. I do not want the shares, and I do not want to actually see it go all the way to expiration. They might exit it. If they say, no, James, I actually don't mind owning the shares, I'm going to let it play itself out, thinking that it might stay in between those strikes, they're going to say, look, give me the potential assignment to buy the shares. If that stock actually goes to the upside, they might get the maximum gain, but it really is getting now very, very close to the end, okay? Now, in this case, my favorite, wonder if it goes down, and it goes down a lot. This is where we would say the price is below the strike. The price is below the strike. This is what I call damage is already done. I mean, you have a high percentage of max loss, okay? High percentage of max loss. And in that high percentage of max loss, there's not a whole lot to do because the damage has already been done and you've profit and loss wise, in this case, loss. But the biggest actually thing is here, you've run out of time. Now, the one thing I want to kind of say with what happens if the stock, for example, closes, we're saying that it closes above the strike. The options, worthless. What does that actually tell us about max gain? Well, you should have got max gain. The options expire worthless, means the stock is above both strikes. Now, what happens in this case if the stock is in between the strikes? Well, you could be a break even. You have to verify that. Okay, break even, where's that number there? BE, break even. The biggest thing that we would actually say in this case is if it closes in between the strikes, you probably actually own the stock. Okay? Now, whose shares are they? They're yours. You can check the liquidity and do what you want. Okay? Check the liquidity. What happens with the long put? Worthless. Expires. Okay? Worth less. And what happens in this case if the stock actually closes below both strikes? The ML, the max loss. Okay? That means that the short strike was assigned, and what you'd actually now have, which is where you exercised, okay, and you actually have max loss. Trade's over, okay? So this is kind of how my mind, I like to kind of think about this table. Let me kind of show it just real quick. I got to wrap up here. And what you're now going to kind of see is when we do these trades, this is what's going to really be going through our mind here in terms of the gains, the 4 to 10 days to expiration, and at expiration. All right, now, what do you think your homework is? Your homework is to actually go out and put your plan together. Write it out. It doesn't count if you don't write it out, okay? If you want to kind of make some big gains in your investing, write out a plan. You really start to trade with purpose and specific intent. Now, I'm out of my time here today. We got Brett Crowther coming up next on our next class, so join him. I'd like to also say thank you, Connie, for answering those questions in chat. Has this been helpful to break down this week on Tuesday, the cash secured puts and also the short put verticals? You feel like it was helpful? That was the intention, okay? Now, just know that throughout this year, this will be the framework of really how we're investing and picking strategies, okay? And also the kind of the rule set, if you will, in terms of managing those positions. Now, remember with what we discussed here today was done for example, illustrative purposes only. Remember that all investing involves risk. You don't have to pick options. You could just say, it's interesting, but I'm going to do stocks. That's fine. But our classes, we talk about stocks and options. So today's focus was on short put verticals. And like I said, go back and review the calendar of other classes that I've actually done. That way you can actually find them and review them as well. Stay tuned for our next class coming up next. And don't forget to subscribe. Thanks so much. Take care. Bye-bye.